Welcome to the Allan Small Financial Show. As always, I'd like to thank all of you for taking some time out of your busy day to share it with us. Markets have been quite confusing over the first half of this year, to say the least. I was talking with a client just the other day, and they were saying, once upon a time, whenever we saw some good economic data, we thought the market was going to go higher, but then the market went lower. And most recently, good economic data actually meant the stock market going higher. Why the difference? We've touched on it in previous shows that said the market at times can be bipolar. What's good news is sometimes bad news. What's good news, maybe today is now good news again. There's a lot of confusion out there for individual investors. So what a great time to have this show to answer all the questions that you have. Basically, all the things you're wondering about the markets. Will they continue to rise? Will they start rising here in our country? We haven't seen a big gain in the Toronto Stock Exchange this year, although the US markets, some of them are up almost 30% for the year. So where are we, and where are we going in the future? So on today's show, we have a lot of topics I think that will go a long way to answer those questions. Off the top, we have a great conversation with Jonathan Chevreau. He'll be our guest today. He expert financial journalist, been doing this a long time. We'll get his take on where the markets are right now. Again, we have our usual This Week segment, where I talk about what I believe individual investors need to know before you make your investment decisions over the next couple of weeks. TSX forecast for year end. What do I think is going to happen between now and year end? As I mentioned off the top of the show, TSX hasn't really done a whole lot as yet, but I think there will be better days ahead, predominantly the second half of this year, where I think the market will gain some traction. So we'll get into why I believe that is the case. What is the most precious commodity in the world today? No, it's not oil. No, it's not gold. It's time. And we'll talk about why I think time is so important for individual investors. Tracking the jobs market. Federal Reserve, Bank of Canada are consistently tracking the jobs market, seeing how the job market is faring. Are people finding jobs if they're looking for them? Are we starting to see people laid off? How is the jobs market going? And that goes a long way as to how the Fed and Bank of Canada are going to react. Will they raise interest rates into a strong jobs market? The answer sometimes is yes. If we see the jobs market starting to weaken, perhaps that is a sign that the Fed and Bank of Canada may take their foot off the gas from all these rate hikes. And lastly, before we get to your questions, oil. Can't help but to notice that the price of oil has been stagnant. It's been sitting somewhere around $70 a barrel WTI. We've seen Brent oil, which is the price of oil overseas, fall as well. And even here, oil in Western Canada also having some difficulty gaining some traction. So why is the price of oil falling, especially as some major players in the world continue to cut oil production? So we'll talk a bit about oil. And as I mentioned, lastly, we'll get to your questions. If any of you have any questions during the show, during my interview with Jonathan, or anything that may spark some interest, please put it into the chat box or make a comment on whether it's YouTube or whether it's Facebook or Twitter or anywhere else. Please, I'd like to know what you're thinking about the show and questions that you may have regarding the show. So without further ado, let's get on with the show. So I'd like to welcome Jonathan Chevreau to our show. John is an author, CFO, and founder of the Financial Independence Hub, North America's gateway to financial independence, the investing editor at large with Money Sense magazine, and many of you may recognize him from the personal finance column he wrote at the Financial Post for 19 years. Welcome to the show, Jonathan Chevreau. Thanks for coming.
Thank you for having me, Allan.
My pleasure. And I know for some of you that recall, we had Jonathan out last year, and markets have changed a lot since then. And as usual, want to strike up a conversation, it's a general conversation, and get your thoughts as to where you think markets are today. So, overall, where do you think we stand with respect to the markets? We have the US markets up quite a bit for the year. We have a few charts that will show that. The NASDAQ up about 28-30% for the year. S&P 500 up about 12% for the year. Whereas the TSX, struggling a little bit, only up a few percent this year. So I guess to sum it up in one question, would you be an investor today, or would you be on the sidelines?
Well, I'm never I'm never on the sidelines, nor to advocate it. I believe in long-term strategic asset allocation. That said, obviously we've come off a terrible 2022. It was the worst year for balanced funds and balanced ETFs in like more than a decade. You tell me, maybe 20 years. As for the U.S., I mean, they just declared the S&P 500 back in a bull market just last week, and largely on the basis of those 7 big mega cap tech stocks, Apple, Nvidia, and some of those, Microsoft. Meanwhile, Canada, yes, sort of mired with a lot of the energy and the resource materials, even the banks, a little bit iffy. Personally, I'd say it sounds like a chance to rebalance a little bit and take some profits from the big mega cap U.S. stocks as the S&P broadens out. The market kind of the bull broadens beyond the 7, and redeploy some of those profits back into Canada.
Yeah, what you say makes a lot of sense. Last year was I think the 4th worst year since World War II for the S&P 500, down over 20%. I know the NASDAQ down about, I think, even over 30% last year. So even though the run we've seen in those 2 indices, still not back to where we were prior to or at the end of 2021. So yeah, you make a great comment. The traditional 60-40 split type of portfolio really struggled last year. And yeah, perhaps a good time to diversify. Would you look at buying some of the areas of the market that haven't participated in the rally yet? Or would you jump on the tech bandwagon and maybe own some names in that space?
Well, I was always on the tech bandwagon, since I used to be the Globe and Mail's technology reporter back in '84. So I've always had, again, but it's strategic. To me, tech is one portion of a diversified portfolio. Yeah, I own NVIDIA, and I have for a few years, but I'm sure you can find a few dogs in my portfolio as well. A lot of people got caught up in the 2021, 22 SPACs and IPOs. A lot of them were technology, and I can show you a few names that are down 90%, particularly in the EV space. So personally, at my age, I just turned 70, so I know your readers and viewers will be probably a little younger, 10 or 20 years out from retirement. But even though I'm not leaving the markets. Yeah, it's a nice time for the fixed income portion of one's portfolio to be in, GICs, kind of ladder over 5 years. I mean, you get what, 5% now, and so that's nice. I was chatting with a few people. There's a bunch of investment writers that have lunch every spring, and a couple of them were for the Globe and Mail, and they were all talking about, apparently that's the big one ETF does it all pick over there is VBAL. My daughter is in the first home savings account, just started it up to buy a home. And I said, what do you want to do? She said, oh, I'm just out of VBAL, Dad. I'm dollar cost averaging. She's 31.
Yeah, no, it makes a lot of sense. And I know we have a couple of charts on the NASDAQ. We can show those S&P showing how much they've grown and how well they're doing over the past really 6 months or so, and TSX not doing as well. But overall, I want to kind of flip our conversation over to Bank of Canada. And overall, there are a lot of pushback with respect to what the Bank of Canada did most recently, raising 25 basis points at their most recent meeting. Do you think they were justified to start raising again? Obviously, they paused as of January. I think it was 2 meetings that they didn't raise again, and I guess they felt the need to raise rates. I know inflation went up from 4.3% in our country to 4.4%, but would you have remained on hold, or do you think they were justified to raise those rates?
I don't think you can criticize 25 beeps either up or down at this point. I mean, clearly they're still nervous about inflation, as they are in the States. The data the last couple of days, even in the States, has been relatively favorable. Inflation is still there, but it's coming down. I think first of all, I think Canada paused, didn't we? And then we went back in. Right now, later today, we're expecting the Fed to be on pause. At least 2/3 of the pundits think it's going to pause. Another third think maybe they're going to just inch it up another 25 beeps. I don't think it's significant. It's not for me to criticize the Bank of Canada. I think they're doing a reasonable job. And again, if you have a diversified portfolio across all asset classes, geographies, market caps, etc., I don't see the need to really worry too much. As for the fixed income portion of a portfolio, again, it's an opportunity to lock in rates we've never had for 5 years or so. Compared to 2022, which was, if you survive 2022, so far 2023 is looking pretty good.
Yeah, and again, another great point. I guess it just depends on what type of investor you are. Many individuals that are in retirement looking for that steady income for many years, I know they would say to me, Allan, we can't be in these fixed income products. They just weren't paying enough interest. Now they're in that 4 or 5% range, 4.5%, 5% range. I know you go to the US, you can buy like 30, 60, 90-day treasuries that are 5% yields. So things have changed quite dramatically, and I'm sure things will continue to change. But you bring up later today what the Fed is going to do, and I struggle with that. A lot of people think they're going to be on hold or pause to perhaps raise again in July. So I'm just thinking, if the Fed thinks that they're going to raise in July, they might as well just raise today in June. I just don't see the reason for a pause. And then when you talk to certain individuals, they say, well, they just want to take stock of what's happened. They've raised rates 5% basically, or 11, 12 times in the last just over a year. And they want to see if it's justified. And then you talk to others and they're saying, well, they're done. If they pause, they're not going to go back into the water and raise again. But then again, you had Canada, Australia, pause and then raise. So again, more confusion for the average investor. Do you think the US should raise? Like, do you think they're going to? I know the talk is they won't, but would you expect a raise later on? Do you think their economy is still hot enough that they will have to raise?
Yeah, I mean, they've raised what, 10 times in a row now. So I think almost everybody expects them to pause today. I think it's sort of like we're at the end of they want to make things look stable at the end of the first half, at the end of June, which leaves, that way they can say, we're halfway through the year, and now we can see the data. Now, I would expect late in July that they will raise another 25 beeps. Then we'll see. Maybe they'll be done. Maybe be another 25 September. I don't know. But obviously, we're a lot closer to the end of the hiking cycle than we were a year ago. I mean, we're already into kind of uncharted territories. It all depends on whether this much feared recession happens or not, which I guess we can talk about.
Yeah, and you're right. I think we are closer to the end of the hikes, and I think that's why the market is doing as well as it has, or as well as it's doing in the U.S. And hopefully we can get our banking sector, get a little bump up in the price of oil, not too much because we don't want to pay more at the pumps, but that'll help the oil sector, the banking sector here in our country, and we can see the TSX move higher as well. But at the end there, you mentioned the word recession, and I guess to sum up, or to the last question I have for you for this show is, do you think we're gonna fall into, or maybe a mild recession? Do you think we're going to have a bit of a soft landing where we don't get really a recession? What are your thoughts? I think everyone's pricing in a recession over the next 6 to 12 months. I've never priced it in fully myself. I always thought there was a chance for a soft landing, that we could kind of skirt by, maybe get down to flat line, but not move into the red. What do you think? Do you think a recession's in the cards here in Canada and or in the US?
Well, some people seem to think that we're going to have some sort of recession. So if you kind of have, that gives you a lot of wiggle room. If you ask me, are we in for some sort of recession in the next 6 months to a year, I'd say, yeah, some sort, perhaps. Whether it's mild, soft landing, that's all just semantics. Again, I don't think it really affects people. It shouldn't affect your investing strategy. I mean, I suppose if you really believe it's going to be bad, you can kind of like keep in cash what you already have, take profits on the NVIDIAs and the AI stocks if you've got them, big, massive gains. But I don't think there's any need to panic. And there are defensive areas. I mean, I know Dale Roberts is often, I rerun his blogs. He's a cut the crap investing on the Independence Hub. And I've run a couple of interesting pieces by him which talk about where the defensive ETFs are. And he likes, for example, consumer staples ETF. Staple, for example, is a BMO ETF. A global, there's a
there's one iShares, one of the Canadian ones, which is basically just grocery stores. Pharmaceutical and health is another sort of defensive sector. Utilities, global utilities. I think Harvest has a global utilities ETF. So there are areas you can shelter in. You don't have to just shelter in cash and GICs. Again, nobody can predict the future. No one asset class is ever going to be perfect. I mean, right now, Wall Street's starting to talk about China and emerging markets. I mean, Gordon Pape in the Globe and Mail today, that is on Wednesday the 14th, was singing the praises of China and emerging markets for the first time in a long time. You look at your portfolio, that's been down, but that's the art of investing. And I'm sure you would say the same to your clients, Allan.
Yeah, no, 100%. And I actually take it one step further. I actually think a lot of this recession talk was built into the market even last year when we saw the markets fall as much as they have. So I agree. I think you keep your investment strategy. Obviously, there are places to move into for defensive purposes. But overall, I think if you're an investor, that's all part of it. And over time, this ends up a blip on a chart and you just move forward. But Jonathan Chevreau, I want to thank you for joining us this afternoon. Always a pleasure having you and sharing your ideas about the markets. And I look forward to having you back again down the road.
Thank you, Allan. Anytime.
All right. All the best. Take care. So now we're come to the part of the show where I talk about what I believe is important for individual investors to consider before you make your investment decisions over the next few weeks. And as always, I have 3 topics that I want to touch on. And these are more hands-on topics than I usually have. I usually talk about Fed and economic data and things like that. But I found myself recently really focusing on portfolio construction and wanted to share some ideas with all of you. So the first point I think individual investors should consider at this time are trimming profits. I think there are a lot of individual investors that have money in areas of the market that have done extremely well. Well, I think at this point in time, trimming some of those profits make a lot of sense. Once you trim the profits, our second point is, what do you do with the cash? Well, you buy names that have not yet risen. There are a lot of areas of this market that haven't gone up yet. We always talk about the breadth of the market being very narrow. So that leaves us with a lot of options for your profits or the money you're taking off the profitable investments. And lastly, or the third point, stay diversified. There's definitely this, I guess, feeling or a temptation to put all your eggs in just a few baskets. If we know technology is doing really well, which it has been this year, why not buy all tech stocks or put your money in just a few big tech names? Well, we know over time that doesn't necessarily work. At some point, these winners tend to pull back, and some of the ones that haven't done so well tend to move ahead. So you want to stay diversified. So let's get to the first point, trimming profits. And I think we have a couple of great charts to show some stocks that I've actually been trimming some profits in. Some of the names that you'll recognize. First one, NVIDIA. We've taken some profits in NVIDIA. One of the big tech names, obviously everyone knows NVIDIA is the big chip company, now just over $1 trillion in market cap, one of 6 companies to reach that valuation. And these are NVIDIA produces the chips that power artificial intelligence. We've been hearing a little bit about AMD, which also has chips, and we have a graph on that as well. In that space, AMD is trying to take some market share from NVIDIA. We just heard this morning that Amazon, for their AWS, is thinking about using AMD chips for their artificial intelligence versus NVIDIA chips. So we're starting to hear a little bit of competition for NVIDIA, but both these stocks have gone up so much, I think it's prudent to trim. Now, I'm not saying sell the whole thing. I'm saying take some profit off the table because I think these names can actually go even higher. But I think it's a prudent thing, right? Risk management. You don't want to leave all your profits on the table and then be sorry that you did. You trim a little bit, and then you leave the rest in to hopefully move higher. And I know some individual investors have said to me, Allan, the stock continued to go up. It was a mistake to take some profit. Well, it wasn't a mistake if you're just trimming some profit, because we still own the stock and we still want it to go higher. So maybe we would have made a little bit more money. But what if that stock pulls back a little bit? You'll be happy that you took some profits. A third stock that I've been taking some profits in is Meta or Facebook. Again, another name that we've had on the show many times. And these are, Meta is, I think it's up over 100% year to date. You can see the chart is just unbelievable. They're talking about artificial intelligence. They're talking about their, virtual reality headsets, and along with Apple recently, and they're going toe to toe, those two companies. But they're talking a lot about artificial intelligence. They have their reels and their stories, and really doing extremely well. I think beyond anybody's expectation. I own a lot of shares for a lot of clients, and taking some profit at this point makes a lot of sense. Getting to our second point, which is what do you do with the money after you trim some of these profits? Well, you buy some names that haven't gone up as yet. And I have a couple of here from a few different sectors. Obviously, probably not going to see a lot of tech names here, although I do have one to show you. But we'll start off with Bank of America. Banks have been one of the areas that have not gone up as yet. I show Bank of America because it's the second largest bank in the United States, and a name that I think eventually will rise. You could see Bank of America a few years ago was up to $50 a share. Today, it's not even 30. I could have here TD Bank, I could have Royal Bank, I could have CIBC, Scotia, any of the Canadian banks as well. I chose Bank of America because I think it is a fantastic bank to own. I saw the CEO in an interview with Brian Moynihan recently. He's talking positively. There's no doubt the economy is slowing in the United States and even here in our country, and that is affecting the banks, but it makes it an opportunity to buy. As Jonathan Chevreau said, when you have all these other areas of the market struggling right now, it's an opportunity to buy. The second, stock or chart that we have are of Home Depot. And Home Depot is another name that I've looked at for individual investors that can obviously handle the volatility that owning a name like Home Depot brings. And you can see there has been some volatility, but for the most part, if you look at the right side of that graph, you can see that it's been trading in a pretty narrow range, nowhere near the highs that it was just, again, a year and a half, 2 years ago, over $400 a share. So trimming some profit in tech, buying some Home Depot, I think can make sense for individual investors if, again, you can handle that risk. And the third chart I have, or illustration I have, is a bit different. And this name is Amazon. And one could say, well, that's tech, isn't it? Or, that is considered a tech name by many. And let's say it is a tech name. And this name actually has gone up tremendously over the first 5.5 months of this year. So you could say, well, why are you buying this? This is not down. I'm buying it, or I'm recommending it for certain individuals because I think it can go much higher. So you can buy a name that hasn't gone up higher as yet, or you can buy a name that has already gone up, but that you think will go up a lot more. And that's Amazon. I think Amazon is a name like Google that I think has a lot of room to run over the coming months and quarters. And I think we're just scratching the surface of what Amazon is going to do going forward. The third and last point that I wanted to make to individual investors before you make your investment decisions is this idea of staying diversified. You don't want to put all your eggs in one basket. It's very easy to chase stocks, very easy to chase NVIDIA at this time. All you're hearing is how much potential a name like NVIDIA has. Listen to the CEO, Lisa Su of AMD, talking about how big this market for artificial intelligence is and how much it's actually going to grow. It's going to grow tremendously over the coming years. But do you want to chase these names, or do you want to buy them on good valuations? So I think you want to buy them on good valuations. And I think you need to stay diversified. You want to own some banks. You want to own some retail names. You want to own some tech, some oil, some pharmaceuticals, etc. And this is how you build a diverse portfolio. And this is how you protect yourself in a volatile market. And we've seen markets extremely volatile over the last couple of years. We saw a big drop in the markets last year. Now we're seeing a bit of an upswing this year. So stay diversified. Don't make sure all your eggs aren't in just a few baskets. You want to own names. And again, as an investment advisor and why individuals call on me to help them is to build that diverse portfolio. The job of an investment advisor is easy if everything's going higher, and it's easy for individual investors to even do it on their own if everything's rising. But what if there's volatility? What if the market is going up and down? What if you don't know the next direction? That's when an investment advisor comes to the forefront, builds you that diverse portfolio so that you can be protected when times are tough and maximize returns when times are good. So stay diversified, especially at this time where markets might be heading for perhaps a rough patch. If we do see a continued slowdown in the economy, you want to stay diversified. Coming into this year, I was telling individual investors that I thought the TSX and the New York markets would have a positive year. And everyone was saying, they thought I was crazy. Some people thought, well, rates are going up, inflation is still an issue. There's unfortunately, the war is still going on, Ukraine, China situation, geopolitics, all of that, was on the scene at the start of the year. But the market is definitely showing a lot of resiliency. And I have a chart here, two charts actually, and might be hard to see the actual numbers. However, these are charts going back. Let's take the TSX first, S&P TSX chart. You can see it here. And the main thing to notice here, the numbers might be hard to read. It goes back to 1988. But what you should be able to see is the red versus the green. And you can see on the far right-hand column, that's the percent gain or loss. And what is most important about this chart, going back to 1988, so roughly 35 years, we've only had one time where the markets have lost money on the TSX. The TSX market has lost money back to back. And that was in 2001 and 2002. And if you look at the S&P 500, which is the next chart that we have, you'll notice a similar thing, that everything is green. And then you have actually 3 years in a row of markets falling 2000, 2001, and 2002. But that is the only time that the markets have had a back-to-back years of negative returns. So coming into this year, not that I like to use the word gamble or betting with regards to markets, but if you were a betting man, or woman, you would have said chances of seeing a negative year are quite remote, slim chance, especially coming off one of the worst years we've seen since World War II in 2022. You would have said, well, I don't know how high the markets are going to go in 2023, but the chances are they're going to be positive. And that was the feeling coming into this year. And that brought on, in my opinion, a wave of buying at the start of the year, especially in tech stocks, which was the most beaten up area last year. I know a lot of individual investors came into this year talking about oil stocks. Unfortunately, those have been a poorer performer. The oil sector hasn't done nearly as well as many people anticipated. But overall, it was this idea of let's buy the things that were down last year because they're so cheap this year. The Fed and Bank of Canada are near the end of their interest rate hiking cycle, and this next year to come is going to be positive. And didn't know how positive it would be. Obviously, it's exceeding my expectations in the US right now. In Canada, I anticipated somewhere around an 8 to 10% gain, and we're on pace for that over the course of this year. So overall, I think that if you're looking to the second half of this year, we're almost there now, a couple of weeks left in the first half, I think you could rest assured that we will see a positive outcome to 2023. Obviously, there are no guarantees, but based on history, based on where things are sitting today, I think there's a pretty good chance at the end of the year, you will see a positive number on the major North American indices. So when I ask individual investors, what is the most valuable or precious commodity in the world today? Many people will say gold. Some people will say silver. Some people will say oil or some other commodity that would come to mind. I take a step back and I tell everybody, well, those are all good answers. But to me, the most precious commodity is time. And time is something that we all wish we had more of. I wish I had more of time every day. I wish we had more time to spend with our loved ones. I wish, once we used up time, I wish we could get it back. Obviously, once time goes by, you can't get it back. And as we seem to get older and older, time seems to go by quicker and quicker. So time is something that, in my opinion, is most precious. And time as it pertains to investing. And let's talk about that. And I want to show a chart of the NASDAQ because I think that will illustrate a pretty good, or give us a good example what I mean by time. So last year, I would talk to individual investors. Everybody was nervous. Markets were going down. They were nervous. They said to me, Allan, I've lost money. What's going on? When will I make it back? Will I ever make it back? And I would always tell people, understand that markets go down and markets go up. And what you end up, unfortunately, losing is just time. Now, I say just, but obviously it's a very precious thing, but your money will come back. And the NASDAQ is a perfect example. You can see here at the end of 2021, how high the NASDAQ was. It came right down in 2022 and has surged in 2023. Now, again, hasn't come back to where it was at its peak, but it's getting there. So what have individual investors lost? Well, they've lost time in the market, right? If you hit a high point at the end of 2021 and you don't reach that high point again till maybe the end of 2023, you really haven't gone anywhere. So what have you lost? Well, you've lost time. And I have an illustration here, just a very simple illustration about individual investors' returns. And so let's say you were an investor in year one, you made 10% return, fantastic return, and you're at all-time highs. The next year, let's say it was 2022, last year, and you lost 10%. So basically you're back to where you started and maybe a little bit worse off than where you started. And if it's 2022, stock market, let's say the S&P was down over 20%, you only lost 10%. That's a pretty good rate of return in a market that lost double that. So you're doing half as bad or a lot better than the average market. And then let's say in year 3 and year 4, you make another 10% return in each year. Well, what do you have at the end? You're averaging a 5% rate of return over that 4 years, if you do the math, approximately. You're at all-time highs once again. You would have reached those somewhere maybe beginning of year 4. But, for those that see the glass half empty, they'll say, well, I've lost so much time. And yes, that is true. You're only up 5% when, let's say, your target was 8 to 10% rate of return. Yes, that is true. But the positive way of looking at it is 3 out of 4 years, you've made 10%. 75% of the time, you're making money. I think a great record for success. You're at all-time highs once again. So unfortunately, yes, you have lost time that it takes to invest, time in the market. But what is the alternative? The alternative is staying out of the market and perhaps making a few percent in interest and maybe taking 13, 14 years to double what you invest, or double the rate, double your portfolio size. Whereas if you average perhaps 7 to 10% rate of return, you could double your money in 7 to 10 years. So for those that I know get caught up in the losses at times and they see their portfolio falling, understand that if you own good quality, your portfolio will rise to the top again. Unfortunately, what we can't get back is time. The time that it takes when it falls and the time it takes to get back to your all-time highs again. But the positive is, one positive, before we move on, we can actually help or increase or make things better by maybe buying more of that investment when the price of that investment is down. So we dollar cost average, or we bring down your average cost so it takes less time to get back to those all-time highs. So we can do things to speed up the rebound or to speed up our investments to get it back to where they were. And that's buying more, especially if you believe that investment is good quality and eventually will rise to the top. Tracking the jobs market. Why do we track the jobs market? Well, as I said off the top of the show, the Fed, the Bank of Canada, central banks, they're always looking at jobs data. And we have a chart here I think the first one is the U.S. jobs, most recent jobs report that we saw 339,000 jobs created for the month of May, above what we thought, above expectations on that day, which was a few Fridays ago. I actually thought the market was going to sell off because good news is bad news, because maybe the Fed was going to raise interest rates based on that. Well, the market didn't think so. The market took it as good news is good news, that if we still continue to grow jobs, or the US continues to grow jobs, and we continue to grow jobs in our country, that's a good thing. That means a recession is not in the cards. It's hard to have a recession if there is job growth. But we need to track jobs data because we know central banks are tracking it. And the better the jobs data is, perhaps the more of a chance that the central bank, Bank of Canada, Federal Reserve, or the more of a chance they will have of raising interest rates. And here we have Canadian jobs information here. And you can see that little red mark on the far right-hand side of the illustration tells us that first time in a while that we actually had negative jobs growth. We lost over 17,000 jobs in Canada. So I think, to me, that caused many people to question why the Bank of Canada just raised interest rates. They're raising interest rates in the face of a slowing economy and job loss. That's not a good thing. And many people, a little concerned that if the Bank of Canada continues to do this and we continue to see job loss and a continual slowdown in the economy, does that mean we are going to go into a recession? And would it be the Bank of Canada that may put us in a recession of some sort, whether it's mild or not, because of this rising interest rate environment? So tracking the jobs data is extremely important and something that I think we need to do. I know we have, I think, one more illustration here of interest rates, Bank of Canada policy setting interest rates. We have that illustration, and you can see as job growth has been pretty good, you can see that interest rates have gone up with respect to, I think they've raised rates in Canada now, 10, 11 times. So there you have it. There's the interest rate policy setting. And you can see on the far right how much we've raised interest rates over the past roughly year. So again, we track jobs data. I think it's important for everyone to know the end of June, beginning of July, they're going to have the June jobs report. And that's going to be important for setting policy for the month of July. So before we get to your questions, as I mentioned off top of the show, if you have any questions, please feel free to put them in the comment box. Before we get to your questions, I want to touch just briefly on oil. A lot of individual investors coming into this year felt that the price of oil stocks would do well. And there were obviously reasons for that. You had OPEC cutting production. Most recently, you had the Saudis cutting 1 million barrels a day of production. Now, the Saudis are only producing about 9 million barrels a day, whereas the U.S. is about 12, 13 million barrels a day. You have the Russians still producing, although the Western world is not really accepting oil from Russia at this time, obviously because of what's going on in Ukraine. So a lot of people felt as though oil was the place to be. And we have a nice chart on the price of oil. We can pull that up and you can see how the price of oil has fared. And if you look at oil stocks in general, they haven't really fared too well either. And so I've added to some of my oil positions, mainly for one reason, and that's for the dividends they provide. A lot of the oil companies, what you should know is that they are profitable, even if oil should drop down to, let's say, $50 a barrel for WTI oil. So some of the US names, Pioneer Natural Resources, Devon Energy, some of the Canadian names, Suncor, CNQ, these are names that continue to make money, even if the price of oil stays at around these levels in that $70 range. And so going forward, I predict, or I believe, the price of oil will kind of be range bound. I think at one point in time, I thought the price of oil might migrate north to about $90 a barrel. We could see that, although we have just started the driving season. I know that the U.S. needs to replenish their oil reserves for the country. They took out some of the oil from their reserves to bring down the price of oil, over the last year. Now they got to replenish those reserves. So that's a need for oil. But make no mistake about it, with more and more electric vehicles, more and more other forms of energy, the idea that China, unfortunately for them, is not firing on all cylinders, that their growth rates have slowed, that the global economy has slowed in general, growth rates around the globe have slowed, is not good for the price of oil. And lastly, a strong US dollar is never a good thing for commodities, and especially oil. So if we were to see US dollar weaken, that probably would be good for oil. But having said that, I think if you're going to own oil in a portfolio, you want to be underweight. You want to own good oil names that pay good dividends. And I think that's what you can sit on as you wait for some growth to come from the oil sector. So this is the part of the show where I like to answer a few questions from the audience, questions that I may have received throughout the show, or that I've received throughout the last couple of weeks between our last show and today. Time for usually a few questions. First one here, I am 20 and just starting out in the stock market. If you were to recommend one stock to buy right now as my first stock, what would it be? Well, that's kind of a tough question to answer, because a lot's going to depend on how much money you have to invest, what's your risk tolerance. Obviously, this person is young, so they have a longer time horizon. But I guess the best way to answer that, and I may have answered this question on another show, the best way to answer that would be, I would recommend individual names that you're familiar with, that you can relate to. If you're someone who drinks a lot of coffee, maybe you buy shares of Starbucks. If you have, if you like Disney, if you like, Disney movies or going to Disney World, maybe you buy shares of Disney. If you find yourself shopping a lot on Amazon, maybe you buy some Amazon. Or if you're just tired of paying all those bank fees to our major banks, maybe you want to buy a Canadian bank to make some of that money back. So I think you want to buy something that you can relate to and that you can follow and that hits home with you. So that would be my recommendation. Second question I'll get to here right before we go. How often should I expect my individual investment advisor to be touching base with me? Should it be more than twice a year? Again, I think it's just dependent on the type of year that you're having. I like to be in touch with my clients, whether it's through a general commentary on the markets, through my shows, this show, my radio show, through individual emails, talking about individual changes to portfolios. I like to be in touch with clients, half a dozen times a year outside of the shows. And obviously, if clients watch my shows, they're going to get my viewpoints on a, I guess, bi-weekly basis. So to me, it's all about trying to be there for individual investors. I think individual investment advisors need to be there when you have questions to ask, when times are volatile, when you see something on the news, they need to be there. And as I always tell people, for me, this is not a job, this is a lifestyle. And, investors, my clients, they contact me on the weekends, weeknights. I'm always there to answer questions. And the only time I'm not is when I'm doing shows like this or in meetings. And if people ask me questions, I try to get back to them as soon as I can. So I guess it's different for everyone, but I think investment advisors should be in contact with their clients on a regular basis, as often as possible. So with that, I want to thank everyone for joining us for another great show. Thanks for watching. Hopefully you can catch our next show on Wednesday, June 28th, same time, 12 noon. And until then, I want to wish everyone happy investing and continue to look for those bargains because they're out there to be had.